This is how to invest for beginners to minimize mistakes. Watch closely because the sheer number of options and opinions can drown a beginner investor, leading to analysis paralysis or steering them down the wrong path. While your first investment experience could be the confidence boost you need to go far in this wealth accumulation journey, it could also turn into a nightmare that leads you to swear off investing forever. But what makes a good investment for a beginner? What do these successful investors know that we don't? The best investment for beginners follows 4 simple rules. In this video, I'll walk you through them all. The first rule is one that is by far the most important and yet the most overlooked. You could have the hottest, most sophisticated, most exciting investment in the world. But if the characteristics of that investment do not match your investment time frame in the first place, you're either exposing yourself to excessive risk or compromising your potential return. Which is why step 1 of choosing the best investment for beginners is to nail your investment goals and likely investment time frame. Most of us save up some money, leave it idle for a while, realize it's not doing much, then feel the urge to make this money work harder for us, thinking, oh yeah, I need to invest it, and finally go on the quest to find the best investment that can yield the highest return in the shortest amount of time possible. This is a reckless way to approach investing. You are thinking chasing more money as a goal rather than aligning your investment activity with something important someday, aka your investment goals. If your goal is to save enough for a deposit to buy a home in 2 years, it doesn't matter how hot the crypto market is right now or how much sense famous YouTubers are making about investing in shares. They're not for you. Instead, to make a truly compatible investment takes the time to reflect on your investment goals because your investment has one purpose and one purpose only: to provide the financial resources you need at various life stages. What are you investing for? When will you need access to the money? How comfortable are you with the possibility of your investments going up and down in value? Are you focused on a short-term goal like a new laptop or a holiday? Or a medium-term goal like buying your first home? Or maybe you're working towards a long-term goal like your retirement. Break your goals down into short, medium, and long-term goals. For short-term goals, safety and liquidity are keys, as you will need access to your funds relatively quickly. Consider high-interest savings account. Avoid high-risk investments like shares or cryptocurrencies, as their value can fluctuate significantly in the short term. Saving rather than investing is often the most suitable approach to short-term goals. As we aim to limit risk with this money, we should not expect excessively high returns. In Australia, placing money in a high-interest savings account can yield up to 5.75% per annum. If you have a mortgage offset account, that's even better. My mortgage interest rate is 6%, so placing my money there essentially generates 6% after-tax risk-free return. That's not bad at all. At this point, I want to emphasize that information provided in this video is for educational purpose only and not financial advice. Everyone's situation is different, so it's essential to consider your own personal circumstances before making any decisions. Medium-term and long-term goals tend to offer greater flexibility in terms of exiting the portfolio, providing more runway for higher risk, higher return investments. With varying investment time frames, these goals align with investments positioned at different points on the risk and return spectrum. A diversified portfolio with a mix of defensive and growth assets in appropriate proportion is generally the most beginner-friendly. As your investment time frame extends, along with increased flexibility in accessing your funds and growing comfort with short-term market fluctuations, your capacity to objectively incorporate a bigger percentage of growth assets for the prospect of higher returns expands. I'll show you what these portfolios look like later on in this video. After you are clear on why you are investing, how long do you have to keep your money invested, and what you can expect of the investment, you are ready to move on to the most crucial part of your entire investing journey, choosing the investment. This is the part of your journey that makes or breaks your investing outcome. But if you can choose the right investment type, you will by default improve your chances of meeting your goals. To do this, the most successful investing beginners apply a two-step formula into the selection of their first investment. First, they focus on building the core portfolio. Second, they use broad market low-cost index funds for the core portfolio. The concept of a core portfolio is part of the core satellite approach. The core of the portfolio is like your main dish. It's made up of traditional major asset classes such as cash, bonds, properties, and shares, which provide stability and steady growth over time. The satellite part of your portfolio is like the side dishes. They are smaller, more specialized investments that add extra flavor and excitement to your portfolio. They might offer higher growth potential, but also come with more risk. They are often more complicated to understand compared to the core assets. Examples of this include cryptocurrencies, NFTs, foreign exchanges, options, and commodities. Depending on your risk appetite, generally this part of the portfolio should not exceed 20% of your total portfolio, and that percentage is pretty generous. Personally, I like to keep it under 10%. Way too many beginners get seduced by the hypes of investment that belongs to the satellite approach, and that's all they invest in. This investment might be the talk of the town and appear sophisticated and exciting, giving you social currency because that's what all your peers are talking about. Whatever the reason may be for you, be very careful that this investment should not be your main focus if you are a beginner. In comparison, traditional asset classes like bonds, properties, and shares might seem boring and simple, but they will help you get oriented in the market and test how you will truly feel about the ups and downs. It's like being a roller coaster newbie. Would you first ride the scariest one in the world, or should you start with something less intimidating at your local amusement park? Remember, simplicity is the ultimate sophistication, especially for investing beginners. Got it, traditional asset classes for the core portfolio, but do I go and pick the shares and bonds myself? No, way too many beginners try to be share traders or stock pickers thinking they can outperform the market. But the reality is, even the professionals cannot consistently outperform the market over the long term. So the most beginner-friendly approach is using broad market low-cost index funds, which is also advocated by many seasoned investors. Warren Buffett confirmed this exact point.
The average person will not know enough to know which stocks to buy. They won't know enough to know when to buy them, but they don't have to, because they can buy all of America through an index fund.
Not only can you buy all of America through an index fund, you can buy the top 500 companies of America, all over Australia, the top 200 or 300 companies of Australia, the top 50 companies in Europe, the share market for the entire world, the global investment grade bonds, and the global real estate market. There are literally thousands of indexes sliced and diced in different ways, covering various asset classes, sectors, regions, and investment strategies. Diversification has never been so easy and accessible to small investors with minimal capital. The great thing about this index fund is that they typically have low fees because they simply track specific market indexes and don't require active management. Evidence has shown that the majority of the active managers don't consistently outperform the market over the long term anyways. What does a diversified portfolio with index funds look like? To see everything we talk about so far in action, let me introduce you to my 3-step framework and your question shall be answered. Step 1. Get clear on investment goals and investment time frame. Upon reflection, I would like to invest $50,000 for my child's future. He is just 1 year old, but the goal is to provide this fund to him upon reaching adulthood. I'm quite flexible with when to exit the portfolio. I could give it to him when he's 18, 20, 21, or 25. I'm not too fast about the exact point in time. I understand the concept of risk versus return, and I'm quite comfortable with taking high risk given my long investment time frame. Step 2. Establish the ratio between defensive and growth assets. Defensive assets include cash and bonds, while growth assets include properties and shares. After careful consideration, I opt for a 10% allocation to defensive assets and 90% to growth assets. Then I delve into a more detailed asset allocation. Within the defensive asset class, I allocate 5% to cash held in a high interest savings account and 5% to bonds. Within the growth asset class, I further allocate 15% to global properties, 35% to the US market, specifically the SP 500, 20% to global equities excluding the US market, and living in Australia, and I have a bit of a home bias and I really like the franking credit system, so I allocate 20% to the Australian market, focusing on the ASX 200. Step 3. Conducting research and selecting ETFs. Moving on, I conduct thorough research to identify exchange-traded funds that align with asset classes I've just outlined. In Australia, reputable ETF providers like Vanguard, BetaShares, and BlackRock offer a range of low-cost index funds that suit my investment criteria. It's important to know that I cannot provide specific investment advice or codes. This example I showed you here is by no means the best portfolio for everyone, as it is only a demonstration of a thinking framework of how to turn goals into a selection of ETFs. However, the process of selecting suitable ETFs is relatively straightforward. There are numerous resources available, including educational videos. These providers themselves certainly make it pretty easy for investors to identify appropriate ETFs for their portfolios. Before you go ahead, open a brokerage account and start investing. Make sure you are investing ready by ticking off the items on this checklist in rule number 3. Because if this rule is not followed, you can forget about rule number 1 and 2 for now. Item number 1. Pay off all your high interest debt. Personally, I'll pay off any debt with interest rate exceeding 7%. Examples of this include credit card debt, car loan, and personal loan. You see, the share market typically yields 7 to 10% annually, but this return is not guaranteed and it's subject to tax. The interest charged on high interest debt range between 7 and 25% and is usually paid using after-tax dollars. By prioritizing debt repayment, you are essentially securing a guaranteed return of 7 to 25% after tax. So it's a no-brainer which one you should tackle first. The second crucial item is to build an emergency fund covering 3 to 6 months of expenses. This provides financial securities in case of a job loss or unforeseen crisis. This also acts as a safeguard for your investment, helping you avoid the need to sell assets at unfavorable times. So you have paid off your high interest debt, built up an emergency fund, got clear on your investment goals, and heck, you even nailed your asset allocation and specific investments. The ingredients for a phenomenal start of your investing journey are all there, but it's how you navigate the ups and downs of the journey that takes you from a phenomenal start to a rewarding finish. When it comes to long-term investing success, the biggest thing to keep in mind is that successful investing is a marathon, not a sprint. As a beginner, it's easy to get caught up in the excitement of the market, fueled by dreams of quick riches and overnight success. However, the reality is that successful investing requires discipline, diligence, and above all, patience. It's about adopting a mindset of steady, consistent growth over time, rather than seeking immediate gratification. One of the most important lessons for any beginner investor to learn is that the first 100,000 is often the hardest to accumulate, especially when starting from scratch. Charlie Munger once famously said that the first $100,000 is a bitch, but you gotta do it. For a beginner, there are going to be times you feel that your net worth isn't increasing as fast as you would like. But it's important to remember that every dollar you invest is a step closer to your financial goals. By staying committed and consistent, you will gradually build momentum and reach that milestone sooner than you think. Once you've crossed 100,000 threshold, you'll find that the journey becomes much easier. The power of compounding begins to work in your favor, and your investments start to generate more significant returns on their own. Now let's talk about 2 smart strategies that can help you stay the course and go the distance. One such strategy is dollar cost averaging, a method of investing a fixed amount of money at regular intervals, regardless of market conditions. Dollar cost averaging helps smooth out the highs and lows of the market, reducing the impact of volatility on your portfolio. By consistently investing over time, you will benefit from the natural ebb and flow of the market, ultimately achieving a lower average cost per share and maximizing your long-term returns. The second strategy is automation, which can be a powerful tool for beginner investors to apply dollar cost averaging. By setting up automatic contributions to your investment account, you remove the temptation to time the market or make emotional decisions based on short-term fluctuations. Automation ensures that you're consistently putting money to work for your future, regardless of market conditions or external factors. It's a simple yet effective way to build wealth steadily and confidently over time. Remember, Rome wasn't built in a day. Starting from ensuring you are investing ready, get clear on your investment goals, establish your core portfolio with a diversified low-cost index fund, and employ smart strategies to stay the course and enjoy the journey. It's only a matter of time until you reach your financial goals. If you like this video and want more personal finance content like this, make sure you hit that subscribe button and like this video. Otherwise, thank you so much for watching and I'll see you in the next one.